Actually, we'll take the discussion forward with Jyoti Jaipuria Valentis, who's joining us now on the broader market. Is it getting dizzy now? Jyoti, you've seen so many cycles. I'm sure you must be sitting on very handsome gains on your portfolio as well right now. Are you getting tempted to take some chips off, or you're staying put?
Yeah, Ajay, you're right that, like it was a very easy call when we last came on the show where I said, I'm feeling good about the market because valuations had become reasonable. But valuations have again got a little stressed. They are beyond fair value now. And so from here, I think, it will be better for the market if we get a time correction and a price correction maybe. So I think from here, it's tough to make big money out of this. Better to wait for some pullback. If you have to invest, I would say stagger out your investments over the next few weeks. Don't rush in all in one go today.
Okay, so can you, if you could share, have you been booking profits in any of your positions in the past few days? If not exact positions or stocks, but at
Yeah.
least spaces?
So yeah, on the margin, we've actually built some cash, which we didn't have earlier. So in most portfolios, we are now sitting between 5 and 10% cash. So the whole call has been that, yeah, things have done well. There's some stocks which are starting to look expensive. So we've taken some money off the table now. And the idea is to hold the cash probably for a better entry point at some point.
Yes, so that's a very important point. You're categorically saying that 5 to 10% cash has been raised in areas which have run up. Not many people are actually so clearly spelling it out, Jyoti. So thanks very much for that, because they say that don't ask for a fund manager how they feel. Ask them what are they doing, and he'll come to know. So, Jyoti, where would you be watching out for deploying this cash? So there are two pockets in the market. One which have done very well. Maybe you want to re-enter at lower levels if a cut comes. Which, and the other is which has already done so badly that if they fall further from here, they'll enter value zone. So both pockets. What are your things on your radar?
Yeah, so just to give a perspective, and so for the last 18 months, we've had three very simple themes. The first theme has been that, buy local, avoid global. And that continues to be our theme in some sense, or at least, we are very, very overweight the local place. Like you rightly said, now a lot of these have run up. So it is no longer easy trade, which it was 18 months ago. Because one is valuations over here have gone up, and on the other side, a lot of the global plays are underperformed. The other theme has been within local, we are preferring the investment plays over the consumption plays. And the third theme, which we had from the beginning of this year, was buy stocks, which probably will be gainers from commodity prices falling down. Because as you know, last year, we had a big surge in commodity prices, and we've seen commodities prices come off. But coming back to a little more specific, so on the margin, what we have done, so if you look at two sectors which have underperformed, software and pharmaceutical, we've not yet bought software, though we are looking at it. It's getting a little better for us. Last year, the valuation just seemed too high for us, but now they are coming into something which we think is the comfort zone. So probably bad news on software may make us, start buying a bit in software. The other sector was pharma. So pharma is something which we built positions in the last 2 months. I think that's a sector which has underperformed so far, but things are changing for the positive on the fundamental front. So the US generic price pressure, which was for the last 7 years, we've heard that, and prices have kept falling. I think that is starting to plateau out now. I think, probably things won't be as bad on the US generic side as we've seen over the last few years. And so some of these stocks will start to do well. So pharma is something which we've added to positions in the last 2 months.
Okay, so you will be buying those pharma companies which are exporting to the US, so generic pharma. What about this API variety? Be it the Shilpa Medicare, the Newland, the Laurus, the Divi's, that kind of variety. Would you also be looking at that pocket or not yet?
So, actually, if we think of it, like we break up pharma into three. So one is this, what I call the CRAMs or, the API, like you said. So those were things we were actually owning, like a year ago also. So we owned the CRAMs, we owned a couple of domestic plays in pharma because that is the second pocket I look at. And third is we were avoiding everything which was linked to US generic market. So just now on the margin, we've added to the US generic market, and we probably cut a bit of position to the domestic pharma, not because there's anything going wrong there, but some of the stocks we owned have done very, very well. So it's a good problem to have. But the valuations there then have become very expensive also. So I would say on the margin, we've cut domestic pharma and we've increased weight to US generics, where most of the stocks have done very, very badly for the last 2 years.
What about capital goods? Capital goods and engineering. This has been the favorite space of the market today. ABB India sounded a bit of a kind of a warning. Valuations have run up. Some are saying if you look at 3 to 5 year valuations are justified, but over the 12 to 15 month period, stocks have more than doubled. What's the right way of approaching engineering and mid-tier engineering and cap good variety?
So, like cat goods is the most interesting because this is the one which we got overweight on very, very early. We overweighted this late in 2020 and they've have been spectacular for us. So, now valuations are no longer easy. From here, all the money which you make will probably be a function of earnings growth coming. The margin for error is not high. Like margin for error is very low actually at these valuations. So what we've been doing is generally we've been avoiding or selling some of the stocks where valuations have become extremely high. But it's still one of our largest overweight positions. We have weights in some of the more niche plays, like we own the pipe companies, which are still reasonably priced relatively to some of these other big names which you spoke about. We own some more specialized names which are into shorter duration things, which go more into consumables in the whole space rather than big capex project. So we still fairly overweight capital goods, but it's an area where the easy money's got made. The valuation now is such that you'll probably make money in this, which is less than the earnings growth over the next few years. So at some point, if the earnings growth does not come, then you could see a drop in price. So I would say be very selective now in capital goods. The time to buy any capital good is gone now.
Again, a very important point. Jyoti, power stocks. We were speaking to Power Minister just a while back on our channel. We have seen the entire value chain of power stocks get re-rated. At 135, nobody wanted to buy NTPC. At 14-year high, everybody wants to latch on to. Goldman has upgraded 40% higher target price on NTPC. SJVN and NHPC, the forgotten hydropower stocks, are also back. And then there are cable companies, Wire, Cable and Wire, which are getting 50, 60, 70 time MEG, not CG, is what people are actually calling it. How are you looking at this space?
So, what we really played on this, and this comes back to the capital goods story also. So, we've actually played some things which benefit, which are not directly power companies, but they benefit because renewable power comes into being. So, people who supply to, the wind power or, build something for the wind power companies, who build something for the solar power companies, because that's like an indirect way to really play it, which typically people classify as, capital goods, but essentially they're just a easier way to play probably the power story, because as long as somebody puts up those power plants, these guys will benefit, and that's it's worked as well or probably even better than some of the power companies which you own.
Okay, coming back to that point once again, how's the cushioning in the market looking? The cushioning of one, there is structural reforms, earnings are structural, cushioning of liquidity. So if indeed a correction comes in, and no matter how positives are, how think positives are, but corrections always do, are the falls also cushioned?
So see, I would put it in two ways. Uh, it's been a very sharp rally in the last 3 months, and we've seen a surge of FI inflow. So to that extent, now the market is very vulnerable to anything which goes wrong globally. We'll still have, probably domestic flows which will support the market, because if you just think of SIPs now, essentially we are doing like $1.5 billion of SIPs a month. And so, when you think of the whole year, you probably have $20 billion coming in SIPs, which to some extent will provide a cushion to, if I stop buying or if I start selling a bit, there'll be that bit of cushion. At the same time, the valuation cushion is very low. So markets are not cheap. When the markets are cheap, there's always, okay, this is too cheap now, so it can't fall more. Here, the valuation comfort is not there. So I think it will be actually healthy for the market if we can get a 5-6% correction and we get some time correction, we get some price correction, because it makes valuations a little healthier and things can do well. The last point I'll make here is earnings. Earnings are still decent. So India is one place where earnings are still holding up. They're doing well. My view is, probably in US, you've not seen a recession on the economy, but you're probably going to see a recession in earnings. You'll probably end up this calendar year with a negative earnings growth in US. So in that light, India's double-digit earnings growth will look like really healthy in the world.
Right. All right, Jyoti, we'll let you go on that one. Thanks so much for joining us on this show
Thanks
today.
a lot. Bye.
That was Jyoti Jaipuria. Very practical advice for our viewers.